welcome to the State of the Nation business, brought to us proudly by Corion Capital. And joining us today is Head of Asset Allocation from Corion Capital, Simon Du Plooy. Simon, welcome back to State of the Nation business. We're talking about gold today because there's been the most staggering move in the gold price. Just talk us through it, where gold is now and where it comes from in the recent past.
Mike, thank you so much for having us. And yes, we are talking about the gold bullion boom, as gold has recently reached the price of $4,000 an ounce.
Now, it's had the most staggering move. Just run us through the move over the recent past.
So, Mike, about 2 years ago, gold breached $2,000 an ounce for the first time in history. It was there and thereabouts over a few times. It looked like it might get there, but it didn't quite breach the 2,000 level. However, since it breached that level 2 years ago, it's been pretty much a one-way story. It actually reached $3,000 an ounce at around the beginning of this year, or maybe towards the end of last year. And this was post the Trump election. That sort of stood out as a defining event for it reaching those levels. And then most recently now, towards the end of September, going into October, it reached $4,000 an ounce. And, that's quite a staggering increase. For gold, 100% increase over 24 months is not unheard of, but rarely happens.
Yeah, that is a staggering increase. Simon, what are some of the factors that gold usually responds to certain of factors historically, the store of value idea, and that gold is quite a defensive play. When you've got uncertainty, you kind of want a few gold coins or bullion in your safe, hidden away. What are some of the factors that are making people so uncertain about the financial position at the moment?
So, Mike, I think when you get an extreme move like this, trying to explain it becomes quite complicated. And I think often people are more speculating than working on hard data. But some of the arguments put forward for the increase in price is firstly that central banks around the world have been increasing the gold reserves. But somehow I feel that is not sufficient to cause a large spike. I think, you still sit there with prudent individuals, that won't be buying gold at any price. Secondly, a lot of governments are over indebted. And one way to solve that problem is to inflate the debt away. And I think there's a lot of people that are worried that governments might go down that route and devalue their currencies. And as a result, believing that the price of gold will increase. But lastly, I think there's also a lot of tension in the world. So I think, we've constantly seeing tensions between the US and China. There's constant talk or chatter, I should rather say, in the background, or questions being asked, will China invade Taiwan? That's often, in the news. And that could lead to global conflict. And I think, even it's a remote possibility or a low probability, people believe that, I'm just going to take a bit of insurance policy here. I'm just going to make sure that it might not happen, or it's unlikely to happen. But if it does happen, I've got some sort of store of wealth that I've got available and, at my home or even in a safe at a bank.
Yeah, so it's in a way, it's almost a vote of no confidence in a small way of the financial system. Here I've got something physical that'll always retain some value. Somebody will always buy it from me, and it will retain its value, whatever that value would be. Today it's 4,000, tomorrow it may be 10,000, or the currency may strengthen. Either way, the gold price remains where the gold price is, isn't it?
Not always, Mike. And I think we'll get to that. But there has been some large drops in the gold price over the years, specifically in the 1980s, after the gold boom of the 1970s that peaked in the 1980s. There was also a peak in the gold price in 2011, from which it lost nearly 40% of its value in the subsequent years. So although there's this perception that gold always retains its value, I do think it's very much important when the gold was purchased. And it's usually after a big or sudden increase in the gold price, where it's much less likely to retain its value, at least in the short term.
Okay, well, Simon, we know that South Africa and the South African economy and certain parts of South Africa, especially I'm up here in Johannesburg, city of gold. We know that the historical importance of South Africa was largely due to diamonds in the first flush, and then gold as the real sort of engine of South African development. So let's have a look at the history of South Africa in this gold period. So, we've got this golden era, gold price up here at $4,000, just sort of an incredible thing to see. But let's have a look at the history of gold production. And you've given us this chart, which shows that if one goes back, sandwiched in the middle was South Africa's staggering place in the world of gold production, where we were the number one gold producer for many, many years. Tell us about some of that history of gold production.
Thanks, Mike. Yes, we got this chart from Visual Elements, and we thought it's an exceptional way of showing just how important South Africa was to gold production for nearly 50 years. And especially if people wants to understand, will this have the same effect on South Africa as it did 50 years ago? I think this chart will go a long way in terms of explaining that. So South Africa was the gold producer for nearly 50 years, by far the largest production. It peaked in terms of its share and its outright output in 1970. In 1970, South Africa produced 1,000 tons of gold, and it was 67%, two-thirds of global production. It remained the dominant producer well into the 80s. But subsequently, a lot of things have changed in the gold mining industry. And right now, South Africa is still a meaningful player, but not even in the top 10.
Now, just while we're on that, and this chart shows us that by 1995, we were still producing 50 tons of gold. We're now 500 tons of gold. Now we are down to 100 tons of gold. Still significant, but not what it was. We are not at nowhere near that 1,000-ton level that we were in 1970. How much of this has to do with reserves, and how much does this have to do with changes in doing business? We know that the government basically nationalized mining rights and made it really difficult for big companies to mine. Has that played a significant role in diminishing South Africa's exposure to the world gold market?
Mike, if you listen to the mining CEOs, I do think it has played a role. But that said, the picture is never that simple, and often it also helps companies to have that argument in their back pocket. There's a number of factors at play here. So, for example, one of the reasons South Africa was so dominant in the 1970s is we had our mines are deep underground, deep shaft mining. And at that stage, given the technology available, it could be mined very efficiently, even though it is quite expensive. However, subsequently, a lot of technological changes in the mining industry made it possible for open cast mining to be done at a much more efficient rate. Now, to the best of my understanding, that is why Australia, for example, was in the 1800s one of the top producers, because they had open cast mining, and the technology available 120 years ago, that was efficient. And then Australia sort of fell off the map for about 50 years as South Africa was dominant. And now in the last 30 years, Australia has come back as a major producer of gold. In fact, it's now third largest in the world. And that signals not a change in reserves. It doesn't change, it doesn't signal an influence from government, even though it might play a role. That is purely changes in the industry in terms of gold mine technology and extracting the gold from wherever it is deposited. I think what South Africa's larger constraint is in terms of efficiently accessing this resource and making the most of it for the country is in terms probably much less of the deposits or the ability to get it out the ground, but the ability to export it. So Transnet has been severely constrained for the last 10 years, and rail freight has been on a downward trend, although I do think we have made a turn there. But you can just imagine if freight rail was at the levels that if it had managed to grow in the last 10 years as opposed to decline, the amount of ore, of whichever mineral we would have been able to export, over the last 5 years as commodity prices recovered. So I think it's a complex picture. I think there's many things that play into it, but it's not as simple just to point it to one factor, to say it's government or reserves or one factor.
So simply put, in the 70s, it was easy to go underground with thousands and thousands of men with sort of small equipment. They would mine these very rich deposits, these rich seams of gold. That was probably the most efficient then. Now you go into the outback. There's no real city nearby. There's nothing. You've just got massive machinery, and they strip the earth, and you got literally a handful of people driving big machines. That's really the difference between their mining and what we historically have done, isn't it? Whereas ours were quite close to where people was very labor intensive, and close to where our cities are. In Australia, they've done well away from everybody. I presume that will be a difference.
Yeah, exactly. I'm sure a mining engineer will correct all our small misunderstandings here, but from a layman's understanding, that really is it. You've got these deep shafts going, kilometers underground, which in itself is an engineering feat. Now needing to compete against machinery that doesn't need to go underground, and logic just dictates that it does feel like you don't need to sink a shaft thousands of meters. That's where I'm going, where my mind was going. Thousands of meters underground. The open cast feels like it has to be more efficient.
Yeah, and then we move on to we mentioned employment, and employment is obviously a massive factor in a South African context. 1988. We had 500,000 people going underground or working in mining. By 2000, that had become 200,000. And now we employ about 100,000 in the mining industry in total in South Africa.
So just to clarify, Mike, this is specifically gold mining. And I think it's again to help the audience adjust to how important gold mining was to our economy 50 years ago and 40 years ago, and how it is not that important in terms of the South African economy. So we've got data on the labor statistics, the different sources, quote the numbers slightly differently. But the whole mining industry, the amount of people employed over the last 20 years, 25 years have increased. Actually, it's started at 2000 or 2002, I believe, at around 420,000 in the mining industry, and we had 480,000. It has actually declined in the last couple of years. There was a peak of around over 500,000 people in the whole of the mining industry. So what we really saw is that gold mining employment has, decreased by 80% over the last 30 years, whereas the rest of the mining, the PGMs and other minerals have increased. So whilst overall mining employment over the last 20 years are, let's call it stable, because we also have to factor in population growth, its gold mining is not nearly as big a share as it was. And all of those things play an important role, because gold mining, if you're going that deep underground, a worker willing to do that can demand a higher salary. There's not a lot of people that's willing to work, kilometers underground. So that's also got an impact, and it's also a factor that plays into this whole equation.
Yeah, and when one looks at the impact of this move in bullion on some of the indices on the stock exchange, we see that gold mining companies in the top 40 in 2015 was at 1%, in 2019 was at 4%, 2023 8%, and this brilliant boom has put us all the way up at 18% now. So even though we are not the gold mining country we once were, it still has an impact on our investments.
That to me is actually probably the more astounding fact out of all of this than the gold price increase itself. You had an industry that was 1% of the index, or less than 1% really. To be honest, we just rounded the number up so that there's something to see. But it was out and done in 2015. I still distinctly remember more than one CIO, 10 years ago saying how they believe gold mining is a sunset industry. They don't want to own gold mines. They worry they won't be able to sell the stock in a number of years. It was not considered a sector as part of the. I think one has to remember that at some point the JSE had a gold mining index just for the gold mines. That index no longer exists. It was done away with. And arguably it was probably around that time. And since then, 3 companies, Gold Fields, Harmony, and Anglo Gold, has gone from a rounding error on the JSE to 20%, fifth of the index. So it tells you that, I think it tells 2 things. Firstly, the rise in the share price of these companies, and one can debate if that's justified or not. But secondly, it also points to a lack of the rise in the prices of other companies on the JSE. And you've got, for example, your South African banks trading at very high dividends, very low multiples. A couple of weeks ago, you could buy ABSA at a 9.5% dividend yield. Now, the larger ABSA and Standard Bank, these large banks are as part of the index. If their dividend yields comes down, their market cap will increase and they will be a larger proportion of the index. So it's gold being such a big portion of the index shows you 2 things. Firstly, the rise in the price of gold mines, but also a lack of market cap adjustment for other South African companies, in particular our banks.
Wow. So that tells you a story as to where the next boom potentially sits. And if we look at some of those indices, we've had astounding moves on those indices. Top 40, we spoke about it the last time, this increase in our stock market, where the top 40 has gone up by 33%. The financial index, as you say, only up 5%. The industrials up by 20%, but the resources index up 99%. Incredible moves.
So this is just year to date. So if someone wants to understand what has driven the JSE or the top 40 in particular, to a 33% rise, which is a big year for an index, for an equity index. Now, our base assumption, because you can never predict the future, you work on averages. Now, we think with inflation at 4%, a very good year for the equity index is or an average year, I should say, is 10%, and a very good year is 13-14%. Then like if you can compound at 10% more than inflation, that's a great outcome for any investor. So if you were expecting 13, you got 33. That tells you it's a massive year. And that all comes down to what the resources did. And if you then go and break down that resource index further, you see it was not Anglos, it was not Billiton's, which is by far the largest constituents of the index still. It is the gold mines, and it is also actually the PGMs, the platinum group minerals. So the old Anglo Plat, or now Valterra and Implats. So yeah, this precious metals sector that drove the index this year, doubling in price. And by far the largest increases coming from the gold mines. Gold Fields up 200%, Anglo Gold up 200% year to date. Share price returns that, if you've studied mining stocks, you'll know that it's possible that they do these type of returns, but you never expect it. It just is astronomical numbers.
Yeah, and before we forget lessons from history, we have seen astounding moves in the gold prices before, and just a cautionary tale that comes from that big move you make mention of in the late 70s, where gold price went up by nearly 500%, 485%. That was in the aftermath of the oil crisis of the 70s, a lot of instability in the world, problems in the Middle East. It all sounds very familiar. Rising tensions in the Cold War. But gold price went all the way up to, if I'm not mistaken, the big magical number was $500 an ounce, and everybody said that's astounding. Like, wow, this is fantastic. South Africa was very rich. $1 cost 50 cents. Hard to believe, but true. And then the aftermath of that was not so much a collapse as just a fizzle out, as the gold price declined by 66% in the following 5 years, isn't it? And just stayed there for what felt like forever.
Yeah, so this comes back to the question: does gold retain its value? And if we just go a bit deeper into exactly the mechanics of that gold price rally, is between 76 and 78 it doubled from $100 to $200. Then between 78 and the end of sort of September 79, it doubled again to $400 an ounce. And then in the space of 2 months, it not only breached the 500 number, which I think is where, if you're going to look on your monthly data, that's the numbers you would be seeing. But if you're going to look at daily data on where the gold price traded at that time, you'll notice that in the third week of January of 1980, it briefly topped $800 an ounce. So a real stratospheric level. And you can just see, like once you get those type of rises where something doubles in the space of a couple of weeks, you're now in completely overextended territory. So what happened after that, it promptly dropped back to $500 an ounce. And I think that it sort of was above, let's say above $400 to $500 for most of 1980. And then, yes, you had this fizzle out. It went from 600 to 500 to 400 to 300. It had a little bit of a bounce back, and it came back to 300. And then importantly, what the chart doesn't show, it continued to fizzle out for the next 20 years until it reached a low of $200 in the early 2000s. So if someone bought gold at $300 an ounce in 1978 and they just held on to it, at first they would have felt incredibly rich and that they've made a very wise and prudent decision for taking gold into their portfolio. But if they just held on to it, 2 years later, they were back where they started, and they would have lost out on interest and capital gains in other asset classes. And if they then said, you know what, you never know what happens, I'm just going to hold on to this, you still would have lost a third of your value over the next 20 years. And that's, again, not factoring in just the interest you would have lost. So whilst I'm definitely not saying that gold should not be part of a portfolio, I do think there is, for many investors, for which it plays an important part of their portfolio. And like you said earlier, it could just be simple insurance policy. I think one must caution against believing that what's happened in the past will continue happening in the future. In fact, often the exact opposite happens. And if we then take this lesson from history to where we are now, where is gold going over the next 12 months? Is it going to double to 10,000? That number is getting thrown around a few times. If you go and say, okay, you know what, it doubled 3 times in 4 years, in the late 70s, I don't know, maybe it goes to $20,000. You actually don't know how high this can go, especially if there's a mania and a boom happening, especially if it gets into a mania phase, where people are just like, you buy this because it will go up. There is not a ceiling, or you can't say where the ceiling would be. Let me rather say that. You don't know where the ceiling will be. But what we are worried about at Corion, specifically for our investors, is that the higher it goes in the short term, the more worried we become about a sharp drop in the subsequent period. As a result, we much prefer, our South African banks, which gives you a solid dividend yield, over our gold mines, which continue to take on debt in order to fund further expansion, in terms of from the cash that they raise from selling the gold, and instead of returning that to investors, they continue to take on more debt.
Well, the one thing about gold, of course, is that there's no real, there's a small consumption of it in jewelry and so on, but the majority of it is just a cost, putting it in a vault, security guards, safekeeping, etc. So it is one to be scared of. It's not underpinned by anything else. Those financials and banks, as you say, 10% dividend yield, that is almost unheard of, and possibly a smart move. But Simon, I think you've managed to encapsulate everything brilliantly. Thank you so much for your time. You are going to keep going with your holdings, but you certainly like some of these financial counters. That's the takeaway from today, isn't it?
I think, yes, that is the takeaway. For our investors, we actually underweight gold mining stocks at the moment, although we do have a portion in the portfolios, but not overweight relative to the index. So I think, and that reflects our risk-based approach to our portfolio management style, where we say, you know what, we don't know the future. We don't know if the gold price might double from here. So we do need to own a little bit of the gold mines in order to, to hedge against that risk. But where do we believe the real opportunity lies is in our South African banks, and a number of other places. But if we keep it simple, we just play it gold mines versus SA banks. We do believe the opportunity is much more on SA banks than in the gold mines. And maybe a last parting thought in terms of the gold price is that if the justification for holding gold is an insurance policy against the government or against conflict or against inflation, when do you purchase insurance? Not during the flood, but before it. And this just feels a lot like, if you're purchasing it now for insurance purposes, that it might be too late for that specific purpose.
Well, ladies and gentlemen, if you want to get information like this more regularly, go to the Corion website, corion.co.za, where you can get the Corion report. You can have a look at a whole lot of stuff. Consider them to manage some of your assets. Simon Du Plooy, it's always a pleasure to speak to you. You've always find something interesting to highlight. This has been a fascinating talk through this incredible boom in the bullion price. Thank you so much for joining us on State of the Nation Business. To everybody that joined us today, please make sure that you subscribe so that you can keep on getting this kind of information. Simon Du Plooy, thank you once again, and we'll see you again on State of the Nation Business. Thank you.